objectives of behavioral finance, correct decision making, provide knowledge to unaware investors. It helps to identify the emotions and mental errors, delivering what the client expects, ensuring the mutual benefits. So we have already discussed one example related to mutual benefits that if I'm able to if I'm able to figure out what's my client actually wants, if I'm able to get into his or her brain, so it can help me in the client retention as well as managing to acquire new relationships. So this is one of the objective of behavioral finance, maintaining a consistent approach and examining at the same time examining that approach also. So it helps us into these 4 to 5 key objectives. So at the end of the day, the major impact is it helps in correct decision making and identification of errors. So we have already discussed the characteristics as well as objectives of understanding the behavioral finance. Now, if we'll say that behavioral finance is an art because there is no specific logic behind it till now, which we have understood. It's basically the psychology and emotions. So, is it an art that which can be mastered, or is it a science? There is some science behind it. So, we'll discuss we'll answer this dilemma. We'll find out we'll try to find out the right explanation for it. But before just going to answer this question, I'll just help you out with the significance of behavioral finance also. So the significance of behavioral finance is determining goals of investors. It also defines the investors' biases. It helps us managing the behavioral biases. It helps in the investment decisions. One can also be it. It can also signifies that investors are emotional, and it at the same time it also helps the financial advisors and fund managers. So behavioral finance helps in all these things that so it's highly significant in all these 5 or 6 things which we have discussed, like determining the goals for the investors, helping the financial advisors, managers, helping in the investment decisions. So for all these things, behavioral finance is very significant. Now, decoding this thing, that is it a science or an art or is it both? So we'll go one by one, then we'll see that what actually comes up. So first we'll take it as behavioral finance as a science. So science is a systematic and scientific way of observing, recording, analyzing, and interpreting of any event. So suppose we'll take an example of stock market only. So suppose if we have to invest in some stock or some share, then at the same time we'll do the proper analysis. We'll do what is the industry says about that stock. We'll see the company's performance. We'll check what they have plans for next vision which we are aiming for, means 2 years, 3 years, what company is planning, what is the news regarding that in marketing. So we'll take an informed decision. We'll observe the things, we'll record some data if required, we'll analyze that data, and for then only we'll interpret. But behavioral finance has got its inputs from traditional finance, which which is a systematic and well-designed subject based on various theories. On the basis of behavioral finance can be said to be a science. On this basis, we can say that yes, it can be a science because behavioral finance has got its input from traditional finance, which is a systematic and well-designed subject based on various theories. The theories of standard finance also helps in justifying the price movements and trends of stocks, the direction of the market. So, price movements and trends of stocks will be the fundamental analysis. The direction of market will be the technical analysis. Construction and revision and evaluation of investors' portfolio. So this will all come under the this it will come under the technical analysis basically. So we'll try to figure out that what actually we are trying to aim for. Like if we are doing all this basic analysis, so this sometimes suggests that it is a scientific approach basically. At the same time, if we'll consider it as an art, so if in art we create our own rules and not work on rules of thumb as in science, so there is no thumb rule basically in art. So art helps us to use theoretical concepts in the practical world. At the same time, behavioral finance focuses on the reasons that limit the theories of standard finance and also the reasons of market anomalies created. It provides various tailor-made solutions to the investors to be applied in their financial planning. Based on the above, behavioral finance can be said to be an art of finance in a more practical manner. So, if suppose my frame of mind has already set, so if I take this type of approach, then we can say that yes, it is an art. So, it also helps to guide the investors to identify themselves better by providing various models of human personality. Now, so it's a very subjective matter that whether it's in science or it is an art. So basically, it will depend on individual to individual. So suppose if you are seeing it from a point of view that these are 4 or 5 type of analysis and you are doing that analysis, but you are not deep diving into it, then you can consider it as a science. But at the same time, if you have a fixed frame of mind and you are just applying that model everywhere, you are applying that theory everywhere, so in that sense, it will be considered as an um, it will be considered as an art. Now we'll discuss what behavioral finance helps to decode and tone up. So basically, we'll try to understand what is the scope of the uh, behavioral finance and how it helps us. So firstly, we'll take that it helps to identify the investor's personality. Now, study of this subject helps in identifying the different type of investors' personality. Once the biases of the investor's actions are identified by the study of investors' personality, various new financial instruments can be developed to hedge unwanted biases created in financial markets. So basically, if we are able to identify the different type of investors' personality, we can maybe be able to create different models and different approaches so that the unwanted biases which are created in the financial markets can be hedged. The second, it helps to identify the risks. So because of these various anomalies in the stock market, investments these days are not only exposed to identified risk, but also to the uncertainty of return. So now, because there are various sentiments which are going on in the stock market, there are various anomalies in the stock market. Hence, these days investments these days are not only exposed to the identified risks, but also to the uncertainty of returns. We cannot guarantee anything in today's changing environment. It provides an explanation to various corporate activities. So behavioral finance provides explanation on the behavior of the investors towards the stock once the dividend has been declared, or effect of good or bad news, stock split, dividend decisions, etc., or corporate action. So it also provides the explanation of the behavior of investment. So suppose there is a bad news in the market for a certain stock, then the people will start thinking that the share price may come down. So they will ultimately start selling the stocks rather than caring about the horizon of next 2 years or 3 years. They'll see that they have to save as much of their money right now. So they'll start selling and ultimately it will just crash the market. So it also provides the explanation of various corporate activities. It helps to enhance the skill set of investment advisors. So it can be done by better understanding of investors' goal, maintaining a systematic approach to advice, uh, earn the expected return, and maintain a win-win situation both for both the client and the advisors. I think I've missed the second one, which is the type of investors. So, uh, um, no, I have missed the first. Yes, first one, market anomalies we haven't discussed. So it also helps to understand the reasons of market anomalies. Like through standard finance theories are able to justify the stock markets to a great extent, but still there are many market anomalies that takes place in the stock market. Like a bubble is created, or there is an effect of any particular event, or there is a particular date which on which the stock market changes its direction. So these market anomalies remain unanswered in the standard finance. So suppose there is a very auspicious day on which there is a lot of purchase of stocks. It's very great that we have to put money in the stock market. Suppose it's like that. So and but fundamentally there is no such thing that the market buying should go up. But at the same time, on that particular day, many people put the money in the stock market and they buy the stock. So, and this behavioral finance can explain this type of answer, which a standard finance cannot answer. So, these market anomalies remain unanswered in the standard finance, but in behavioral finance provides explanation and remedial actions to various market activities. So these are few of the things which comes under the scope of behavioral finance. Now we'll move on to the next thing, that there are actually two types of um, there are two types of behavioral finance. So basically we call it the branches of behavioral finance. So we basically divide these into macro and micro behavioral finance. So micro behavioral finance deals with the behavior of individual investors. In this, the irrational investors are compared to the rational investors. So basically, the micro thing is related to the individual investors, whereas the macro behavioral finance deals with the drawbacks of efficient market hypothesis. So EMH, we'll discuss this in detail in the next coming slides. So EMH is one of the models in conventional finance that helps us understand the trend of the financial market. So we are going to discuss this model in this coming slide. So we'll now move on to the behavioral finance concepts. So first we'll try to understand the difference between the standard and the behavioral finance. So till now, what we have learned that standard finance is basically is related to the structured approach. So there is a particular answer or a science between each and every action. So suppose there are a set of formulas, there are a set of theories, there are standard practices which needs to be followed to find a concrete explanation of an event which is happening. Whereas behavioral finance is not related to that. It can be a science, it can be a art. It is subjective in nature. It is basically dependent on the emotions. It is basically dependent on the psychology. We have already seen that sociology, psychology, and finance, all these are interrelated, and it comes down to the behavior finance. And when we add economics and psychology together, so the behavioral finance can be explained from that front. So basically, both are quite different. Now we are going to understand this in a much deeper way. So coming on to this topic, standard or traditional finance. So standard finance versus traditional finance. So just before moving on to the this topic, uh, we'll just quickly discuss some market strategies. So market strategies can be market timing, technical analysis. There is one thing, that efficient market hypothesis, which we are going to discuss in this. So as I've already explained, that it helps us in doing the fundamental analysis in the investing market. So we'll discuss this. And there is one more point which is called as the uh, pyramid scheme. It is basically sketchy and unsustainable. It is some kind of business model which we are going to discuss. So these four are the market strategies. So you can just write these four down. The first is market timing. The second is technical analysis. Third one is pyramid scheme, and fourth is efficient market hypothesis. So basically, these helps four strategies helps us in the stock market. So market timing is an investment or trading strategy in which market participants attempt to beat the stock market by predicting its movements and buying and selling accordingly. So I'm trying to predict what's going to happen next. Accordingly, I'll try to buy or sell my stocks or commodities. Market timing is opposite of buy and hold, a passive strategy in which investors buy security and hold them for a long period of time, regardless of the market volatility. So basically, we have learned about the intraday trading or options trading. So in this, it's not like delivery that we have taken a certain number of stocks and we can keep it as with n a number of years. So basically, we predict the market. We accordingly I buy and sell in a particular day. Suppose if I talk about the Indian stock market, is generally starts from 9:15 till 3:30. So between this time period, I can do multiple actions. Like I can buy some stocks also, and I can at the same time sell some stocks also. So it depends on this. So market timing is the opposite of buy and hold, which is also known as the delivery. So it is a passive strategy in which investors buy securities and hold them for a long period of time, regardless of market volatility. While feasible traders, portfolio managers, or other financial advisors and professionals, so market timing can be difficult for average individual investors. So suppose if I'm a working individual, but I at the same time I have to put some money in the stock market. So I just have to track each and every moment. But I have already one job in my hand, so I won't be able to do that type of analysis. So it is going to be difficult for me. But if there is a full-time traders or portfolio managers, their whole bread and butter and their whole job is this only, trading. So it is feasible for those people. Second is technical analysis. So in trading, technical analysis is a method which is used to forecast the direction of the market price or the strength of the trend by analyzing the past market price. So we follow a basic trend. So it helps us to predict the market price, the direction of the market price. Technical analysis, basically in trading, it focuses on the charts and other technical indicators to forecast the market. The three now we'll discuss the three fundamental principles behind technical analysis. So first is a market price action discounts. So market price actions discounts everything. So wherever the market is trading now, that's the fair market price. All the hopes, maybe fears or market expectations, they are all factored into the price. So if the market is going up, it can move down. Ultimately, it will get averaged. Markets move in trends. So the markets take a while to go to wherever they are going to go. So there will always be a trend. So if you'll see for a graph or a particular stock, it over a period of time, suppose it will be like a sine wave. So it will follow a trend that in particular duration or in particular cycles, we can just predict that the wave is going up and then it's going down. So it will be like a sine wave or some kind of pattern you will be able to find out if you will do the proper analysis, proper technical analysis. The third assumption is that history tends to repeat itself. So price levels there were vital in the past can often be important in the future. Again, it's an old saying that history repeats itself. So the price levels that were vital in the past, as rightly said, can also become important in the future. Next will be efficient market hypothesis. So I'll just give you a gist of this that as per the definition, the EMH, which is efficient market hypothesis, it is also known as the efficient market theory. Basically, it is the hypothesis that states that share prices reflect all information and consistent alpha generation if is possible. According to the EMH, stocks always trade in their fair value on exchanges, making it impossible for investors to purchase undervalued stocks or sell stocks for inflated prices. Therefore, it should be impossible to outperform the overall market through sorry, through expert stock selection or market timing. And the only way an investor can obtain higher return is by purchasing riskier investments. So this theory tells us that stocks always trade in their fair values or on exchanges. So neither we can sell on inflated prices, neither a buyer can buy on the low prices. So this theory, this is the gist of EMH, what EMH tells us. Now the fourth and the last point of strategy is pyramid scheme. So a pyramid scheme is basically a it's sort of a sketchy and unsustainable business model where a few top level members recruit newer members who pay upfront costs up the chain to hold to those who enroll them. As newer members in turn recruit underlinings of their own, a portion of subsequent fees they receive is also kicked up the chain, often called pyramid scams. These operations are illegal maybe in some countries. So pyramid scam is basically, suppose we can just assume a pyramid. So basically I'm hiring few people. So those fewer people are passing out some commission to me. Now they are also hiring 3 or 4 more people. Those 3 or 4 people are passing some commission to the people who I have hired, and ultimately some share is coming up to me also. So as newer members in turn recruit underlinings of their own, a portion of subsequent fees they receive is also kicked up to the chain. So I also get some share. So basically this is forming a pyramid. So often these are called as the pyramid scams. These operations are maybe some illegal in some countries. And this is not a sustainable business model, basically. So these are 4 of the market strategies which are followed. Now, we'll talk about the standard finance versus the behavioral finance. So the pillars of standard or traditional finance are basically built on the notion of homo economicus or rational economic method. So this is a Latin term. So rational economic method. So it states that investors being rational all the time make perfectly rational economic decisions. This actually postulates that how investors should behave in idealized manner. On the contrast, behavioral finance emphasizes on how investors actually behave in the real world situation. This modern theory are focusing that investors are not rational, they are quasi-rational or irrational. This is backed by the notion of psychology of each and every individual, which is distinct from one another. If all investors are rationally figure out the whole picture, then why some investors see the green grass or some gets nothing out of the available information, which is common to all. Hence, behavioral finance can be elegantly works upon the observed behavior rather than the idealized one. So, as I've said, that behavioral finance now in this thing can be a science, if I'll say. So, behavioral finance basically it is dependent on my observations, what actually I'm observing, and accordingly I'm taking some decisions. At the same time, standard traditional finance is basically depending on the rationals. So it's like the ideal situation that this is the thing, this is what my formula says, and this has to be the answer. But at the same time, behavioral finance takes care of the other factors also, psychology, sociology, the various other factors which are overlooked in the standard finance, which cannot be formulated in a particular through a particular formula. So there is a very observant line between both the practices, standard finance and behavioral finance. So I'll quickly tell you 3 or 4 things regarding differences of behavioral finance and standard finance. So people processes data correctly, this will come under the standard finance. And there are no thumb rules, this will come under the behavioral finance. If there are logics and reasons, then logic and reason will come under the standard finance, while emotions and herd thinking, herd instincts, which I have discussed in the very beginning, this will come under the behavioral finance. Markets are always efficient, this will come under the standard finance, while market are somewhat efficient or inefficient, this can come under the behavioral finance. Standard finance assumes that risks and returns assume both are transparent, but the behavioral finance, it assumes the risk and return under the dependence frame. So basically, there it will seek for some other factors also. So these are 4 or 5 key differences between um, standard finance and behavioral finance. Now we'll discuss the efficient market hypothesis. So large set of investors and not one investors can influence the market adversely. We can say that information affects the market, and we'll talk about the flow of data and information as well as the transparency of risk, which we have discussed. So EMH is being based on the notion that it is impossible to beat the market. In this market, share prices follow an independent path. It is being associated with the idea which was traced by a French broker in 1863. His name was Jules. So the theory he proposed was named as the random walk theory. So random walk theory asserts that information is opaquely seen in the stock prices. As soon as information is being flown, it reflects in stock prices immediately. The daily fluctuations are being dependent on the news, and this news is unpredictable. Because of this, resulting prices is random and the returns are as generous as received by the experts. The efficiency of stock market lies in the line of reflection of the available information of the stock prices. Hence, EMH states that stock always trade on a fair value and there is no opportunity for investors to earn abnormal returns by means of buying undervalued security or by selling the inflated security. The belief of this EMH is also tied up with the conviction that nobody can outperform the markets and one can only earn higher returns by purchasing the risky securities. So, in simple terms, what EMH says that it is impossible to beat the market. Whatever the price of a stock is there, which is shown in the market, this is the fair value. I cannot sell on inflated prices, neither I can buy on the very low prices. So the efficiency of stock market lies in the line of reflection of the available information on the stock prices. And the stocks always trade on the fair value. Hence, there is no opportunity for investors to earn high returns, very, very high returns, by buying very undervalued stocks or maybe selling the stocks on the inflated securities. So there are a few bases on, efficient market hypothesis is based on few factors, like no single investors can influence the market unduly. If suppose there are 10 different things and it is already said, then a negative opinion cannot, or a negative person cannot influence the market unduly. There will always be a free flow of information and data. There will be large number of investors which are present. There will be always be full disclosure and transparency, and prices reflect correct information fact. So these are few of the bases on which efficient market hypothesis is basically standing. Now we'll talk about the some forms of the market efficiency. So one model was introduced in 1970 FAMA model, farmer contribution. So the farmer contribution in 1970, it was backed by a CAPM model, which holds the securities markets are efficient. It exclaims that all priced securities fall on SML, because of which there is no opportunity of under and overvaluation. The internal and external efficiency is necessary so that lower transaction cost and high transaction speed can be saved. Along with this, absorption of any information must be in an unbiased manner. So basically, there will be three types of forms of market efficiency. So first will be the weak form, second will be semi-strong form, and third one will be the strong form. So the weak form of market holds the phenomena that all historical sequences are reflected in the stock prices. The price of the stock budges with the random fashion and moves only in the tandem of demand and supply positions. So if there is a high demand, the stock price can rise, and if there is a low demand, the stock price can come down. Thus, historical prices cannot help in forecasting the future prices of the stocks. Therefore, technical analysis is of no use. So weak form says that it depends on the demand and supply, and it doesn't depend on any other thing. At the same time, semi-strong form suggests that the efficient market states that the stock price does not reflect the historical series of activities, but all those information as well as which is publicly available. The disclosure of corporate reports, financial statements, etc. is available to each and every investor. Thus, superior returns cannot be earned on a regular basis. It asserts that the results are predictable and investor cannot take advantage of the fundamentals. Thus, fundamental is of no use. So basically, it says that the results are predictable and investor cannot take advantage of the fundamentals. So the first theory was negating the technical analysis. The second semi-strong form is negating the fundamental analysis. It is saying that fundamental analysis is of no use. Now comes the third form, which is the strong form. Beyond the historical prices and publicly available information, this strong form of efficient market postulates that insider and hidden information is of no use, because investor cannot earn any abnormal returns giving due respect to full disclosure and transparency. So there is full disclosure and transparency. Hence, insider trading or some internal use cannot have any impact on the stock price. The strong market absorbs all the information and news, whether it is of past, present, or insider information. All the prices are independent of maybe various happenings, similar to random walk theory. So basically, the three forms, and all three forms are negating one of the theory. So which is related to the standard finance. Now, the first one is rejecting the technical analysis. The second one is rejecting the fundamental analysis. The third form is sort of negating the market information which is there. Hence, these basically are the forms of market efficiency, which comes under the behavioral finance. Now we'll discuss the adaptive market hypothesis. So we have discussed EMH. Now we'll discuss the adaptive market hypothesis. So AMH, adaptive market hypothesis, is basically the research that modifies the efficient market theories with behavioral economics, asserting that markets evolve over a period of time as individuals utilize biases to make investment decisions. Market tend to be inefficient because investors have a bias towards survival rather than rational economic decisions, profit and utility. Markets have cycles. It also has trends, panics, manias, and crashes. Rather than being efficient, markets have anomalies, and that can be exploited by the investors. So EMH tells us that it is the research that modifies the efficient market theories with behavioral economics. Now, EL combine EMH and BF in this behavioral economics, behavioral finance. So, asserting that markets evolve over a period of time as individuals utilize biases to make investment decisions. So, we'll discuss few of the biases in later in our course. So, this EMH, basically there are three things in this. First is technical anomaly. There are five things in this. Basically, first is technical anomalies. So, technical analysis of charts and volume history can be used to forecast future stock prices. Technicians will also analyze relative strength, moving averages, and support and resistance. Second one will be fundamental anomalies. Fundamental analysis of valuation metrics, including price to earnings, price to cash flow, and price to book value, can be used to find companies trading below their intrinsic value. Studies have shown historically undervalued stocks tend to outperform the broad stock market over the long term with less risk. Arbitrage opportunities, often derivatives such as convertibles, preferred stock, and options can be mispriced by the market. More inefficient asset classes. So historically, some capitalization stocks, international stocks, and venture capital investments have tended to be the most inefficient and the best long-term opportunity for investors. However, they tend to have a higher standard deviation and a great deal of risk as well. Now there is a one effect which named as a January effect. Stocks tend to rebound from tax loss selling at the end of the year. Returns tend to be abnormally higher for the month of January than the rest of the year. So this is adaptive market hypothesis, in which the efficient market theories are modified with the behavioral economics. So we are trying to mix and match. So hence that we can see that this January effect is trying to suggest some pattern, which, as mentioned, that stocks tend to rebound from tax loss selling at the end of the year. Returns tend to be abnormally higher for the month of January than the rest of the year. So basically, behavior economics is also there, that I'm suggesting something. At the same time, economics is also there, that there was some data which has said that there is a loss which has happened at the end of the year, and it's a quite pattern that in November, December the loss is happening, but at the same time in January the stock prices are comes up. So basically there is a combination of both things which is described here. So this comes under the EMH. Now we'll discuss the expected utility theory. So expected utility theory, if we, as we can see in this slide, there are three graphs which I have shown here. So one is high risk, one is high risks, second is neutral risk, and a low risk. On x-axis I have plotted the wealth, and on y-axis I have plotted the utility. So what expected utility theory tells us? So through though the expected it was basically coined initially with the description given in the terms of mathematical explanation by Nicholas in 1738. It was regarded as the classical theory of utility. It was not basically intended to describe how people actually behave, but how people would behave if they followed a certain requirements of rational decision making. So one of the main purpose of this theory was to provide an explicit set of assumptions that underlie rational decision making. When researchers documented the violations of the assumptions, the theory was revised. So, as said that initially it was regarded as the classical theory of utility. Basically, it was not intended to describe how people will actually behave, but how people would have behaved if they followed a certain requirement of rational decision making. One of the main purpose of this theory was to provide an explicit set of assumptions that underlie rational decision making. When researchers the violations of the assumption, that this theory was revised. So this is a enhanced version of this theory which was initially proposed. So this theory was introduced by Nicholas Bernoulli in 1738, but it was revised by John von Neumann and Oscar Morgenstern 1944. So it stated that the market participants make their decisions under risk by comparing the expected utility values of the available alternatives. So basically, this will be a comparison between the will will identify the risk, and it will be a comparison between the wealth and utility. So rational investors acts to maximize their expected utility, that is calculated as weighted sums of utility values multiplied by their respective probabilities. It categorizes the decision makers into risk averse, risk neutral, and risk loving individuals. So basically, low risk, neutral risk, and high risk individuals. So there is a risk averse investor is concave. So there is a concave curve which is explained in figure number high risk, one and third, which is the high risk and the low risk. So low risk is the risk averse and high risk is the risk loving individuals. So this implies that for an increase in expected wealth, the utility function of a risk averse person decreases. So risk averse is the low risk. So if we are saying that for this, the curve is going up, but at the same time, it is getting decreasing. It's stabilizing, and it is showing that it can come down. So this implies that for an increase in the expected wealth. So as we will move on the positive side of the x-axis, we'll basically going in the positive direction. So our wealth is increasing. So for the expected wealth, increase in the expected wealth, the utility function of a risk averse person decreases. In other words, in the normal language, if I'll explain, for the same amount of utility, which is there on the y-axis, for the same amount of utility, a risk averse person would like to take a lesser risk comparing to the risk loving person. So the risk averse person will try to take less risk for the same value of utility. So it explains the difference between investors' behaviors with respect to the risk tolerance. This theory, along with the variants like subjective expected utility theory, was the most accepted theory for decades in financial literature and decision making under risk. The rationality of agents turned out to be the key to unlock the stock market behavior. Alongside this assumption, several corresponding theories were developed that established the groundwork of standard finance theories. The predominant theories amongst these were Markowitz's portfolio theory was one, and the capital risk pricing model was also developed. So it was the two theories and one model which were developed. So these helps to establish the groundwork of standard finance theories. Now, a great deal of asset pricing theories is based on the assumption of market efficiency, which is introduced by Eugene Fama in 1970. I have already discussed this thing earlier also. So he defined the efficient financial market as one in which security prices always fully reflect available information. So basically, the stock price, which I'm saying, is at the fair value. All the things are good, all the information is transparent, nothing can affect, no single investor, no single bad news can affect the stock price. Everything which is presented, it is right, according to this. So he defines the efficient financial market as one in which security prices or stock prices fully reflect available information. It further identifies that in an efficient market, all the investors are well informed, rational individuals who aim to maximize their profits. This means that if the efficient market hypothesis holds true, then the investors cannot hope to beat the market, and no amount of analysis would help in generating abnormal pattern. So basically what we are trying to figure out, why, how does the market moves? Again, we will come down to the very first slide or very first topic, that what impacts the investor decision. So it is their behavior, it is their psychology. Suppose if there is a news in the market, and if 10 people are trying to sell their stocks, then it will create a herd effect. I'll also, maybe because of fear or some things in my mind, I might also end up selling my stock. So because of these situations, there is the anomalies which are present in the stock market. But EMS theory is totally opposite to this. It is a very rational thing, that everything which is there, it is fair. If now we'll say that if everything is fair, then I cannot beat the market. I cannot predict anything. If there is a 10 rupees stock, I have to purchase it at time. Now, if because of the calculations tomorrow it goes on 11, then only I'll get 1 rupee profit. And same with the others. But there is nothing which I can do on it. I cannot predict it, and that it can go on 12. Suppose there is a news in the market, so I cannot judge that over a long period of time that a news can impact. If it will impact, then accordingly the calculations will be made, and according to EMS theory, the what will be the stock price, I have to purchase on sell that stock after 2 months or 3 months on that. But I cannot predict anything. So this is the basic difference between what. So this is the situation which we are trying to explain here, and this is the thing which we are trying to differentiate the mindset and the theories, which both are as of now. So it further identifies that in an efficient market, all the investors are well informed, everything is very good, and we cannot do anything about it. So this means that if the efficient market theory holds true, then the investors cannot hope to beat the market, and no amount of analysis would help in generating abnormal returns. So this theory takes the standard finance literature one notch higher by taking into account irrational traders. It notes that the irrational or noise traders can distort the prices, but it is a temporary phenomena and is quickly eliminated by RB triggers. The theoretical and empirical assumptions of EMH, I'll just illustrate a few theoretical assumptions of EMH. Investors are assumed to be rational. Therefore, they value the securities rationally, incorporating all the available information. Irrational investors, if present, trade randomly. Therefore, their trades cancel each other out without affecting the prices. Further, the effect of irrational investors on prices is also eliminated by the trading activities of the arbitrators. The empirical assumptions of the EMH turned out to be an enormous empirical success in the first decade of the conception. Hence, it is stated that there is no other proposition in economics which has more solid empirical evidence supporting in than the efficient market hypothesis. The empirical focus of the EMH has two aspects now. The first considers the impact of new information on security prices. So basically, it states that any new information in the market can be incorporated in the security prices quickly and correctly, such that prices trends or reversals could not exist after the initial impact of the news. And second is that since the price of a security is equal to its value, therefore it should only move when there is a news about a change in its fundamental value and not otherwise. It is further noted that in an efficient market scenario, old information has no monetary value. So this Pharma in 1970, he categorizes the old information into three types, which gives us the three forms of market efficiencies: weak, semi-strong, and strong. Weak form of market efficiency, the past prices and returns are taken as old information, and here technical and trend analysis cannot yield superior abnormal returns. So we have already discussed these weak, semi-strong, and strong uh, 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 these the three types of forms of market efficiencies. So weak form is totally negating the effect of trend analysis. The semi-strong form basically negates the fundamental analysis approach, and the strong form basically negates the role of the information or insider traders, which can affect the investors. So however, investors can still earn abnormal returns by having information that is not made public, that is insider trading, which is I'm kind of talking about the strong form. Here comes the importance of strong market efficiency, wherein even insider trading cannot provide abnormal return in this information, leaks out quickly and gets incorporated into security prices. For a very long period of time, these theories were considered to be ultimate explanation for investor market behavior. However, in recent times, researchers have been observing that traditional theories get significantly violated in actual market conditions. Now, they have started accepting that these theories are based on the oversimplified assumptions. If foundations are built on how market participants ought to behave rather than how they actually behave. This led to the emergence of behavioral finance, which factors irrationality and biases of investors. Talking about the semi-strong form of market efficiency, as have already explained that it negates the fundamental analysis. So any public information, available information is considered old, and its fundamental analysis also fails to give superior returns. This means that as soon as the information becomes public, it gets incorporated into security prices. So ultimately, whatever price is there of a particular stock, suppose there is a XYZ stock which is trading at 100 rupees as of some XYZ day on 2 p.m. suppose, whatever the price is there, it is because of a certain news, and that certain news has already affected the price. So now if I have heard a news that this some corporate action has been taken, and in mind I'm feeling that the stock price can go up or can go down. I'm just figuring it out. At the same time, when I see that price, what this theory suggests, EMS theory suggests that it is already there. The effect is already there on the price, and now I cannot do anything about it. I have to purchase it or I have to sell it. I cannot predict anything. I cannot think that finally that price will go up or that price will go down. Should I hold the stock? Should I leave the stock? So it's EMS says that I cannot do anything. It has already assumed few things, and it is uh, continuing its basic, which is there. So everything is already incorporated. The price is very fair. All the information has played the role. There are large number of investors, and no single investor can influence the market unduly. The prices already reflect the information effect, whether it is positive or negative. There is full flow of information, free flow of information, full disclosure and transparency. So this is what my EMH suggests, which is the efficient market hypothesis. While if I talk about the AMH, so adaptive market hypothesis, it helps me. So basically it modifies the efficient market theories with behavioral economics. And it says that markets tend to be inefficient because investors have a bias towards survival rather than economic decisions, profit and utility. It asserts that markets evolve over a period of time as individual utilizes biases to make investment decisions. So these two theories are slightly, I can say these two theories are quite different. Slightly is the wrong word which I have used. And this is how standard finance and behavioral finance basically are different. So if a decision is data driven, a decision is based on logics and reasons, it's if it says that markets are efficient, and it's assuming that all the risks and returns are transparent, then this all will come under the standard finance. Whereas behavioral finance says that there is no perfect thumb rule for any type of decision. There are people who are taking decisions based on the emotions and the herd instincts. Herd instincts means my neighbor is doing something, I will also do the same thing. Or 10 or 20 different people are doing something, I'll continue doing that thing. I won't apply my mind. I won't apply any technical, fundamental, or analysis flow of information. I won't consider anything. I'll follow the herd instinct. If behavioral finance says that markets are somewhat efficient, they are not fully efficient, but somewhat efficient, it also assumes the risk and return under the frame of dependence. So basically, both are dependent. This is what the behavioral finance tells us. So we have understood the standard finance versus the behavioral finance. We have understood the EMH, efficient market hypothesis. We have understood the EMH theory. Now we'll move on to the next topic.